The double bottom pattern is a bullish reversal pattern, because the pattern is initiated by a downtrend and finalized in an uptrend, and occurs mostly at the bottom of a downtrend. The double bottom chart pattern belongs to the price action technical analysis techniques. The pattern is characterized by forming two bottoms located approximately at the same level. There is a small upward correction between two lows, also known as a W pattern, due to the two touches at the low and a change in the trend direction from a downtrend to an uptrend. It is very effective in predicting a change in a trend direction when identified correctly. However, they can be extremely detrimental when they are interpreted incorrectly. Therefore, you must be extremely careful and patient before jumping into conclusions. A horizontal line is drawn at the highest point of a rebound and at the two touches at the low. Double bottom pattern is one of the strongest reversal patterns because of the power generated by the traders. It is easy to notice. Due to that reason, a lot of volatility comes into the market. The double bottom pattern is found in any financial market, including stocks, bonds, forex, cryptocurrency, and commodity markets. The double bottom pattern is formed both in short-term and long-term timeframes, from 5 minutes to monthly ones. The price of a security moves up after a first bottom and it will hang around at the high for some time, indicating a hesitation to go downwards again. This generally means that the demand for an asset is on upstick but isn't strong enough yet for a breakout. A double bottom pattern consists of three parts. First low, first price reversal. After a downtrend, the market bounces higher. At this point, it might be just a retracement in a downtrend, not an indication of price trend reversal. Second low, second price reversal. The second drop is formed as the market discounts the previous downtrend and the buying pressure increases. There might be sign of a price reversal to an uptrend. However, it is still too early to say if the price will continue increasing. Area of resistance. A resistance level is the maximum price an asset can achieve over a period in an uptrending market between two lows. A double bottom pattern is complete if the price breaks above the resistance level, indicating there are more buyers than sellers and the trend is likely to continue moving higher. Once again, it is very important to have key components when it comes to double bottom pattern. Downtrend. The double bottom pattern occurs at the end of downtrend or in the end of bear run. It's extremely important to have the downtrend. First low, interim high, second low. The first bottom should be the lowest point of the current trend. The distance between two bottoms shouldn't be too short. Generally speaking, the longer the duration between two lows, the greater the probability that the pattern will be accurate. Also keep in mind that support, which is level between two lows, shouldn't be far away from each other, in terms of price. It should be in range between 0 to 5%. Breakout. Pattern is confirmed when the price breaks above the interim high, signaling that the bulls have taken control of the market. Volume. An extremely important factor. The volume should be higher during the second low and breakout, indicating greater buying pressure and conviction among traders. The double bottom pattern should be used in conjunction with other technical indicators and analysis techniques to make well-informed trading decisions. Do not forget that. Let's get to the chart. Here it is a great example at the screen right now. Distance between two lows isn't too far, but is still a great example. It is daily time frame. As you can see, there was a long and strong trend down. At first low, market pulled back quite quickly, forming an area of resistance. But at this moment, it was just another small peak up. Price afterwards continued to fall until it reaches an area of previous low. Touched that right into the point and retraced with quite a huge volume, which indicates bull power. Market continued to climb, breaks resistance area, even retests it, and moves up with a huge strength. Great to watch that happens. When it comes to expectations, you should at least expect price to move distance between two bottoms line and resistance line. And in this particular example, price climbed way higher as you can see. Let's talk about the double top pattern now. Double top pattern is equivalent to double bottom, just reversed and consists of uptrend, first high, interim low or area of support, and second high, breakout below area of support, volume after break, pattern considered to have occurred when conditions are met. Let's search for an example in live market. Long and strong bull market. Here at this point we reached new high of a market. Then there was a pullback. At this moment there is no any pattern. It might be just the same trend up. However, market again receive a pullback from the same point, which is our double top. Market didn't cross the area of support right away, but after a period of time it breaks with quite significant volume, and it is so obvious. Head and shoulders. This pattern is called under the name of shampoo and was noticed long ago, and even relative these days for a bit. Head and shoulders pattern is also belongs to the price action technical analysis, and it is bullish reversal pattern. Pattern itself predicts that the bears soon will have control of the market. The head and shoulders pattern consists of 3 peaks up, a central peak flanked by 2 smaller peaks popping all over the place. The head and shoulders pattern forms when a securities price rises to the peak and then declines back to the base of the prior up move. Then the price rises above the previous peak to form the head and then declines back to the original base. Finally, the price peaks again at about level of the first peak of a formation before falling back down. To detect head and shoulders pattern, you need 4 main components of it. After bullish trend, the price retraces, thus forming the left shoulder. The head forms when the price peaks above previous peak and then declines to a point at or near the previous low. The right shoulder forms as the securities price rallies once again but fails to reach its previous high before falling again. A 4th component is neckline, formed by drawing a line underneath the troughs established just before and just after the head. When the securities price dips below this trend line, it indicates that the pattern has occurred and represents the point at which bearish traders start selling. The pattern also indicates that the new downtrend will likely to continue until the right shoulder is broke, where prices move higher when the price is at the right peak. Even when the stock price breaches the neckline, it doesn't necessarily mean it's locked to continue in that direction. You still need to consider a few more factors. First, volume. It is one indication of a strength behind the price move. With the classic head and shoulders pattern, you'll see that trading volume starts to lessen as the price moves higher towards the head and then again when it rebounds from the right shoulder, indicating limited bullish power. A spike in volume when the price moves below a neckline suggests that the selling pressure will remain intense. If neither of these volume signals is in play, the decline may be short, or might be that the price will not cross the neckline at all. The second factor to consider is trend. Since it is trend reversal signal, it requires strong or at least moderate trend leading into them. Uptrend heading into the pattern should be visually way longer than distance between shoulders, at least twice as long. This makes it more likely that any reversal of a trend will likely to be. When traders is using this pattern for trading, the trade opened right away after the price crossed the neckline. However, to use it these days would be a bad idea. In combination with your risk management, to expect the movement to reach your target based just on a pattern is unreal. Pattern could be used to identify the further movements and for general price prediction, but never as a single signal into trade. Head and shoulders pattern has quite a few negative sides of it, of which is unfavorable risk-reward ratio, hard to notice for new traders, large stop loss, and there is a big question about success rate when it comes to statistics. Let's get to the chart and identify that pattern. First, we have uptrend. First shoulder distance between shoulder top and bottom is not so obvious, therefore it can be interpreted differently. Anyway, at this point wasn't any pattern. Market kept going upwards, forming the head, dropped up to the price of first shoulder, and finally forming the second shoulder, and a neckline as well. Now we need to wait for the breakout, and it obviously did with great volume. To determine target, measure the vertical distance from the head to the neckline. Find the breakout point, where the price first breaks the neckline, which is here. Your measured distance is your target below the breakout point. Wedges. A wedge pattern is a price pattern identified by converging trend lines on a price chart. The wedge pattern is frequently seen in traded assets like stocks, bonds, futures, and any other. The characteristic feature of a pattern is narrowing price range between two trend lines that are converging towards each other, creating a wedge shape. A contracting price range paired with either an upward price trend, known as a rising wedge, or a downward price trend, known as a falling wedge, defines the pattern. The wedge pattern has three common elements observed in each scenario. Firstly, the trend lines that are converging towards each other. Secondly, the volume tends to decline as the prices progress through the pattern. And finally, there is a breakout from one of the trend lines. Traders wait for a breakout to occur above or below the wedge to enter the trade. However, there might be other strategies among the traders than breakout. A wedge pattern is a popular trading chart pattern that indicates possible price direction changes or continuations. Wedges, which are either continuation or reversal chart patterns, indicate a pause in the current trend. The price has to reach a trend lines at least 5 times, 3 times on one side and twice on another, before a breakout. Wedge patterns comprise support and resistance trend lines that move in the same direction as the channel narrows until the one trend line is broken. Wedge patterns are important in technical analysis because they can give traders a clear picture of future trend reversals or continuations. Wedge patterns should be used in conjunction with other technical analysis techniques. Traders look at trading volume levels to verify a possible price reversal signaled by a wedge pattern. There are 4 factors that identify a wedge pattern in the chart. First, the market must be in trend. You must first determine whether the market is trending. You might check for definite direction by looking at the longer time frames. Second, 2 levels. Third, the level should be narrowing. This narrowing creates a wedge shape. And finally, the volume must be declining. There must be decline in the volume as the pattern starts developing, as the trend starts to reverse because fewer and fewer traders are participating in the market. A wedge pattern can signal either bullish or bearish price reversals. In either case, this pattern holds 3 common characteristics. First, the converging trend lines. Second, a pattern of declining volume as the price progresses through a pattern. Third, a breakout from one of the trend lines. The 2 forms of a wedge pattern are rising wedge or a falling wedge. Rising wedge. A rising wedge usually occurs when the price has been rising over time, but it can also occur in the midst of a downtrend as well, so do not get stuck on an uptrend only. The rising wedge pattern's trend lines continue to keep the price confined with them, forming higher highs and higher lows. While price can be out of either line, wedge patterns have a tendency to break in opposite direction from a trend line. Therefore, rising wedge pattern indicates a more likely potential of falling prices after the breakout of the lower trend line. This particular wedge pattern is a bearish and suggests that the price is set to fall and trend downward. Falling wedge. This pattern is created when the market is in downtrend and prices make lower highs and lower lows, which results in the formation of 2 contracting lines. However, same as with rising wedge, it is not the case all the time, so it can appear in an uptrend as well. Before the lines converge, the price may break above the upper trend line, When the price breaks the upper trend line, the security is expected to reverse and trend higher. Therefore, falling wedge pattern indicates the more likely potential of climbing prices after the breakout of the upper trend line. So rising wedge has a bearish effect, and the falling wedge has a bullish effect. Let's get to the chart. Here it is a climbing wedge. It is not perfect. In live markets rarely happens the perfect pattern. However, it is there. Market was climbing over time, it is no doubts about that. 3 touches on a up and 2 touches on a downside. Volume declining, especially at the end of pattern formation, indicating the weak bullish power. And finally, last thing is breakout, which happens here at this point. And trend kept moving downwards with quite significant power. Here in another example, we have falling wedge in a downtrend. The volume decreases as the patterns are forming and then increases when it breaks out, as you can see in the chart. The volume decreases during the wedge and then grows as the market exits the pattern. The wedge pattern successfully managed to reverse the downtrend. Trading with wedge patterns in combination with other technical analysis techniques could be highly beneficial. It helps traders depict the price movements, it's easy to identify, and there are clear entry and exit points. Anyway, traders should keep good attention, because false breakouts occasionally occur with wedge patterns. Also, wedge patterns are difficult to analyze, because they can signal both bullish and bearish results. There are lack of volume confirmations as well. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.